Gold's up 98% in 2 years. Stocks hit a record high during a war designed to crash the economy. Every crisis since 2008 has ended with assets at all-time highs, and not one of those pipes belongs to you. Let's walk the dominoes. 3 names own a piece of every public company in America. Those 3 names are BlackRock, Vanguard, and State Street. The Bebchuk-Hurst working paper out of Harvard pegs their combined stake at more than 20% of the entire S&P 500. Together, they manage about $25 trillion in client money. That's larger than the gross domestic product of the United States and China combined. And that's just the part you can see. 11 trillion. That's the size of the American passive index fund market right now. In 2024, passive funds quietly overtook active funds for the first time in history. Every paycheck that lands in a Vanguard target date fund routes through the same machine. And the machine doesn't get to decide which stocks to buy. Here's the part the fund prospectus says out loud but nobody actually reads. An index fund is, by legal mandate, price insensitive. When you put $1 into a fund tracking the S&P 500, the fund doesn't ask whether Apple looks overvalued. It doesn't ask whether the price-to-earnings ratio is at a record. It buys every company in the index, weighted by market capitalization, on the same business day you sent the dollar in. The bigger the company is already, the bigger a slice of your dollar goes to making it even bigger. By now you're thinking, wait, that can't be how the largest pool of money in the world is allocated. That's exactly how it works, and it's working as designed. The whole pitch of index investing is that nobody's picking individual stocks. The fund just owns the market. What that actually means is the fund is a permanent, uninformed, automatic bidder for every share, regardless of price. The richer the rich get, the more cash hits the funds. The more cash hits the funds, the more shares they're forced to buy. The more they buy, the higher prices climb. And the higher prices climb, the more savers pile in chasing the gains. This is the Big 3 forced bid. 3 firms, 25 trillion under management, a regulatory obligation to keep buying. The Fed could raise rates to 10% tomorrow, and the Big 3 would still have to allocate every paycheck dollar into the same 500 names. That's why the old low interest rates explanation stopped working in 2022. Rates rose sharply across that year. The Big 3 kept buying through every hike. The S&P climbed alongside the rate increases. The two were supposed to move in opposite directions. That stopped being true a long time ago. The math gets brutal once you scale it. When a passive fund owns more than 15% of a stock, the dynamics change. An outside seller trying to dump shares can't find a buyer at the previous price because the largest holder is mandated to hold. So prices grind up not because anyone believes in the company, but because the share float that can actually move has shrunk to nothing. The Big 3 have effectively locked up 1/5 of every major American company in a vault that by mandate doesn't open. Now this is where the rich buy asset story gets right what nobody else explains and then stops short. Yes, when the rich get government money during a crisis, they buy assets. But buying assets isn't a vague behavior, it's a specifically routed instruction. The cash gets deposited at a private wealth advisor. The advisor allocates across a Vanguard fund, a BlackRock fund, a State Street fund. Within 90 days, every dollar of that crisis bailout is sitting inside the same 3 institutions, which by their charter can't do anything except buy the index. There's no analyst deciding whether Tesla's a buy. There's a software process that buys the index on schedule, regardless of valuation. The Bureau of Economic Analysis puts American household wealth at about $160 trillion. The top 10% of households own about 93% of all stocks. The bottom 50% own roughly 1%. So when you hear that the stock market is at a record high, you're hearing about a wealth gain. That gain almost entirely accrues to the same people the deficit checks went to in the first place. The deficit funded the rich. The rich routed that cash into the funds. The funds bought the same 500 stocks they always buy. Prices climbed to record highs. Meanwhile, the $4,000 median bottom half retirement account sat there earning 1.2% on a money market sleeve. But forced bidding from the outside is only half of the price machine. The other half doesn't even need a saver, or a wealth advisor, or an index fund at all. Because the company itself walked into the market and started buying its own shares. And once you see how big that one is, you'll realize the index funds aren't even the loudest pipe. Turns out the second pipe doesn't need anyone outside the boardroom. The company spends its own cash to buy its own stock. The Securities and Exchange Commission says S&P 500 companies have spent more than $9 trillion on share buybacks since 2009. That's more than they spent on factories. That's more than they spent on research. That's more than they spent on workers, by a wide margin. $943 billion. That's how much S&P 500 companies spent buying their own shares in 2024 in a single calendar year. For comparison, the entire federal budget for K through 12 education is about $80 billion a year. Corporate America spent more than 11 times that, buying back its own paper in 12 months. Here's the trick, and it took the regulators 40 years to legalize it. Before 1982, open market share buybacks were treated as stock price manipulation. A company buying its own shares on the public market was, in the eyes of the Securities and Exchange Commission, artificially supporting the price. Then the Commission issued Rule 10b-18, creating a legal safe harbor. As long as the company stayed under certain daily volume limits, the buyback wouldn't be charged as manipulation. The rule was supposed to be a narrow exception. What it became, over the next 4 decades, was the largest pipeline for corporate cash in modern financial history. Now walk the buyback mechanism step by step. A company earns $10 billion of profit. The chief executive has 2 choices for that $10 billion. The first choice is to invest it in new factories, new products, new hires, anything that grows the underlying business. The second choice is to use it to buy back the company's own shares on the open market. If the company picks the second choice, the share count shrinks. The same earnings, divided across fewer shares, mechanically produces a higher earnings per share number. The price-to-earnings ratio stays roughly the same, so the price per share goes up. Not because the business is worth more, because the denominator went down. That's the buyback pump in one sentence. The chief executive didn't create any new value. He just rearranged the math. But executive compensation is mostly stock-based, and stock options pay out when the price per share rises. So the executive is being paid a bonus on a number he can engineer by spending the company's cash on its own paper. It's the cleanest self-dealing loop in legal corporate finance. Right about now you're wondering, doesn't that money have to come from somewhere? It does, and it used to come from retained earnings. Then around 2015, companies started borrowing to fund buybacks. The Fed's zero interest rate policy made debt almost free, so why not? Apple alone has issued more than $100 billion in corporate bonds since 2013, in large part to fund its buyback program. Boeing famously borrowed to buy back shares right up until the 737 MAX crashes started, then needed a federal bailout. That pattern isn't subtle in any way. The named winner has a name. Apple has bought back more than $750 billion of its own stock since 2012. If Apple hadn't run those buybacks, its share count would be roughly 50% higher today, and the price per share would be roughly half. The market capitalization would be similar. But the headline number, the one that gets written up in the news, the one your retirement account benchmark measures, would be a small fraction of today's price. Apple's stock chart is, in large part, a chart of Apple's own buyback authorization. Now the part that should have been a national scandal. In December 2017, Congress passed the Tax Cuts and Jobs Act. The corporate tax rate dropped from 35% to 21%. The pitch from the Trump White House and the Republican congressional leadership was that the tax savings would fund worker raises and new factory construction. The Congressional Budget Office estimated the cut would deliver about $1.5 trillion in corporate tax savings over the following decade. In the 18 months after the cut took effect, S&P 500 companies spent about $1 trillion on share buybacks. Worker wages, in real inflation-adjusted terms, barely moved. That's the buyback pump in one paragraph. The government cuts corporate taxes by $1.5 trillion. Corporations spend $1 trillion of it buying their own shares. Share prices rise and executive compensation rises with them. Wages, adjusted for the inflation the cut helped fuel, stay flat. The tax cut wasn't a worker stimulus. It was a buyback subsidy. And the Fed kept the pump running through every supposed tightening cycle. Even when rates rose in 2023, buyback authorizations stayed at record levels. Companies just rolled their existing low-rate debt for as long as they could and kept the program going. The pump doesn't care about the macro story. The pump cares about quarterly earnings per share, and buybacks engineer that number directly, on demand, with no underlying business growth required. But here's the rude part. Even if you understood every word of how buybacks work, you still wouldn't own a single share of anything until you bought it. There's a third pipe that doesn't bother with the stock market at all. Because the rich aren't just buying shares of companies, they're buying the house your kid was supposed to be able to afford. The third pipe moves capital the most directly of any of the three, because nothing about it happens on a screen. It moves the actual house your neighbor used to own. After the 2008 foreclosure crisis, private equity firms started buying single-family homes at distressed prices in cash by the thousands. Blackstone launched its single-family rental arm in 2012. That arm became Invitation Homes, which now owns about 85,000 single-family rentals across the Sunbelt. American Homes 4 Rent owns about 60,000. Progress Residential owns about 85,000. Tricon owns about 38,000. The top 5 corporate landlords together own more than 300,000 single-family homes. Each one of those 300,000 homes used to be a starter home for somebody's kid. Now it's a rental, owned by a limited liability corporation, managed by an algorithm, with the rent set by a software platform that maximizes monthly take. Here's how the single-family roll-up actually works in the bidding room. A private equity fund borrows money at corporate bond rates. In the 2010 to 2021 window, that was somewhere between 2 and 4%. With that cheap debt, the fund makes all-cash offers on single-family homes in target metros. The first-time buyer needs a 30-year mortgage, a financing contingency, and a 45-day window to close. The best offer she can put on the table is maybe 5% under list. The fund walks in with no financing contingency, a 14-day close, and an offer at or above list. The seller picks the fund. The first-time buyer goes home and starts watching mortgage rate forecasts. By 2022, Redfin data showed that in some Sunbelt metros, institutional investors were buying up to 1 in 4 starter homes priced under $300,000. That's not a few lost bids. That's a quarter of the entire entry-level housing stock being permanently removed from the ownership market and converted to rentals. Here's the question you'll want to ask. How did this become legal at scale? None of it had to be, and it just wasn't ever illegal. There's no federal cap on how many single-family homes a single corporate entity can own. There's no zoning rule that prevents a limited liability corporation from outbidding a household. The Department of Housing and Urban Development, under both Obama and Trump, explicitly endorsed single-family rentals. The official framing was that corporate landlords would provide a stable rental supply solution to the post-2008 housing shortage. The agency that was supposed to defend home ownership instead defended the corporate landlord model. And the named year matters more than you'd think. 2017 wasn't just the corporate tax cut. The same Tax Cuts and Jobs Act created opportunity zones, which let investors defer capital gains taxes by reinvesting in designated low-income census tracts. Many of those tracts were the same neighborhoods the funds were rolling up single-family homes in. The tax law that fed the buyback pump also fed the roll-up in the third pipe, in the same year, in the same bill. 2 completely different siphons, both routing capital straight to the people who already had it. Now look at what it did to a generation. The National Association of Realtors says the median first-time home buyer in America is now 38 years old. In 1981, that number was 29. A decade of delayed home ownership for an entire cohort. 10 years of paying rent to a fund instead of building equity in a house. 10 years of compounding wealth transfer from one demographic to another. And the rent itself isn't a free market price. It's set by an algorithm. In many cases, it's the exact same algorithm, sold by a company called RealPage. The Department of Justice is currently suing RealPage for coordinating rents across competing landlords. Here's the closing of the loop, and it's the part that should make you sit down. The same households that get squeezed out of home ownership by the roll-up then send their monthly rent check to the same private equity fund that owns the house. That rent payment becomes the trust's corporate revenue, then its quarterly earnings, then a buyback authorization. The parent real estate trust is publicly traded, sitting inside the big 3 index funds which the same wealthy households use to compound their gains. The dollar that came out of your paycheck as rent ends up bidding up the assets you're locked out of buying. Those are the 3 pipes, the big 3 forced bid, the buyback pump, and the single-family roll-up. All 3 were sitting empty in 2008. All 3 have been routing capital nonstop ever since. Every time the government runs a crisis deficit, the cash arrives at the rich. The rich route it through the pipes. The pipes pump it into the same 500 stocks and the same 300,000 houses, and the assets hit a new all-time high. The Iran war isn't slowing the pumps down. It's the next funding cycle. And someone with a Bloomberg terminal and a 70-minute head start already made $200 million on the leak.